Eric Muathe, Muathe.com. Now, we all know that traditionally when we look at the explanation for the RSI, mostly you'll find that they say anything above 70 on the RSI is supposed to be this. Correct? Now, in my opinion, that is absolutely wrong. In fact, let's do an exercise. Let's say instead of saying that that is an area to avoid buying stocks, let's change it. Let's say every time we move above 69.1, and in the description of the video there's going to be an explanation why I get this number. And I think when you find that the RSI for most default charts it's at 70, actually what they're aiming for without knowing it is 69.1. There's a reason why it's 69.1. Check the description of the video. I explain where this number comes from. And anyway, we can use even, let's just say approximately 70. That's fine. No problem. All right. Okay. So let's do an exercise here where we say that the stock is a buy when it moves above 69.1. You sell it when it moves back below 69.1 or 70. So here we move above 69.1, which is somewhere here. We stay and hold on until when it moves back below 69.1, which is sometime here, almost 1 year later. Now let me clear all this stuff so we can see the price level. So entry here at 69.1, but we kind of know that 70, we can use 70 because that's the default, but frankly it's 69.1. all right, we stay until it moves back below. Entry here, exit here. So you manage to move from a price, let's call it here, just over 10. You stay in the stock until somewhere here in the mid 30s, simply by understanding the power of RSI moving above 69.1. Let's continue on. So you enter here, which is this price somewhere there. You get out somewhere here. Now entry, exit. So let's see the price entry there, exit price somewhere there. At any rate, you did not end up losing money. Correct? Let's try it again. You enter here, which is here. You stay in until this period here where it drops below 69.1. Now I can assure you this is why I say 69.1, because this is where it found support. So we can either say that's where it dropped below 69.1, that's fine, which is here. So you entered at this price level, you stayed until here when it briefly drops below 69.1, which is this period here. Now I think it held 69.1, but let's just assume it dropped below that. So that's a price level of under 40. You get out at 70. Still, you're not losing any money, right? In a couple of months. So let's say your re-entry was here, which is this re-entry here, back above 69.1. You hold on, and you'd still be holding on even in the current market. So we're talking about entry of about 70. You'd still be holding on even here. Why? Because the stock is still above 69.1. So those textbooks might be a little bit on the, let's call it, wrong side of explanation of what the RSI is above 70 or 69.1. Now let's assume that this you held on because it did find support at 69.1. So pretty much what it did was this. This is 69.1. It moved above it here, came back, tested it, bounced back above it, which is this entry period here, is this support zone. If we assume that this was your entry, you held on even throughout this bounce, and test of 69.1, you'd still be owning and holding on to this instrument since your entry under $40. So, as I always say, instruments above 69.1 are sideways to outright bullish. This is just another perfect example. Eric Muathe with Muathe.com, an original concept. As always, good luck, peace, and blessings. ECS. Mwah. Woo!